In this week's video, we'll review the latest charts to help us answer the question, stocks, an overextended late-stage bull or a healthy secular trend? The stock market's moved a long way since the March low, thus it's logical to ask and answer. Is the current trend overextended by historical standards? The 6 periods shown on your screen are periods where bad things happened in the stock market. Let's examine these cases in a little bit more detail to see what we can learn about the present day. And we'll start with the 1987 case. If you know your stock market history, you know Black Monday occurred in October of 1987. The highest high before Black Monday was made in August. Let's compare the market's profile here to the market in the present day. And we'll do that by looking at the stock market before the peak in August of 1987. The highest closing high before Black Monday was made on August 25th, 1987 in the upper right-hand corner of your screen. This is the S&P 500 in blue here, and this is the 200-day moving average in red. This is the last day where things really look good. After this, the next trading day, the peaking process begins into Black Monday. Before the peaking process started, it had been 709 trading days since the slope of the 200-day moving average for the S&P 500 was negative. We have to go all the way back to October 31st, 1984, down here to find a day where this slope is negative day over day. Thus, there's not one day between October 31st, 1984 and August 25th, 1987, which spans 2.8 years, where the slope of the 200-day moving average is negative. And on this chart here, the 709 trading days would be out here. How does the 709 days compare to other cases? 1973-74 bear market, 238 trading days. Dot-com bust bear market, an unbelievable 1,293 days had gone by since the slope of the 200-day moving average was negative before the peaking process started. Financial crisis bear market, 323 trading days. 2015-2016, before this sharp pullback here, 807 trading days. Prior to this 10% plunge that began after January 26th, 2018, this is the S&P 500 in red. It had been 421 trading days since the slope of the 200-day moving average was negative. Thus, in each case, it was pretty fair to say the long-term trend for the stock market was fairly extended before really bad things happened. If we perform the same analysis in December of 2020, how does it compare? The 6 periods that we just covered, on average, it was 632 trading days since the slope of the 200-day moving average for the S&P 500 was negative, or roughly 2.5 years before the peaking process began. So in the present day, are we better, worse, or about the same relative to being extended? The answer? Much, much better. The average in the 6 cases that we just showed, 632 trading days or 2.5 years. In the present day, it has only been 31 trading days. It's 95% below this average from these cases here. In each case, the market was extended before really bad things happened. The upper chart here shows price. This is the 200-day in November of this year in isolation. If we look at this on a longer-term time frame, it ticked down slightly. It was basically flat, a very indecisive trend. It could have gone either way in late October, early November, which is much more similar to this look here, a flattish, indecisive 200-day moving average. And it really doesn't look anything like this extended period here prior to the peaking process in 1987. After this is what happened in the S&P 500, a 33.51% plunge. This doesn't necessarily tell us whether the S&P 500 is about to peak, but it tells us historically that this trend could last a lot longer before peaking. It is well within the realm of possibility. That which has been is that which shall be, and that which has been done is that which will be done, and there is nothing new under the sun. That is a fantastic segue into the topic of secular trends. We've covered this topic with clients and regular viewers many times, so we'll be moving quickly. We've added one new little wrinkle: rate of change on the bottom of the screen. This is a very long-term chart of the S&P 500. This is a daily chart going back to 1942. If you're into pattern recognition, some things may have already jumped off this screen. Let's compare this period here to this period here. This is a 21-year period we'll be focusing on from 1996 to 2016. This is also a 21-year period, 1962 to 1982. Let's focus on the orange box first. This is where we enter the box at point A. The box goes from point A to the low at point E, point A to the low at point E. In both cases, we go from point A to point B, and point B is a little bit lower than point D. We go from point A to point B, and point B is a little bit lower than point D here. Notice in both cases, when we come from B to C, C is higher than point E. When we come from point B to C, the low at C is higher than the low at E. And then in both cases, from that lower low, we rally back above the orange box. From the lower low at point E, we rally back above the orange box. Coming back to this case here, we enter the box in 1962, which is similar to entering the box in calendar year 1996. 21 years later, in this case, you've broken out of the box, and this is somewhat of a retest here at the end of the 21-year period, or in calendar year 1982. Have a very, very similar look here. You can make an argument that this is somewhat of your retest look here that occurs in 2015, 2016. And ultimately, this is the market needs to consolidate its gains. This is the consolidation. The market in a secular or long-term trend needs to consolidate its gains. The longer a market goes sideways, the bigger the move you can expect to get. Another interesting point, at the bottom we have rate of change. This is the 186-day rate of change. It had been 186 trading days since the March low in 2020. Notice near point E here, we get a rare and high spike. You can make an argument that this spike here is similar to the spike here in 2009 that also occurs after the low at point E. Also similar, a second big spike. In this case, it occurs in 1983. You can make an argument that that is very, very similar to the spike that we're experiencing in the present day. This chart is dated December 15th of 2020. How this might be relevant in the present day. This point here in 1975 is after the major low in 1974. This point here in 2009 is after the major low in March of 2009. We get a similar rare double spike look here that occurs years later in 1983. We get a similar double spike rare look here that occurs in 2020. And all of this speaks to similar and very, very rare human behavior. And remember, relative to human behavior in the stock market, there's really nothing new under the sun. So using the rate of change look, we can make an argument that 1983 is similar to 2020 or December of 2020. And if we look at this 186 trading day rate of change panel on the bottom, only 3 times in the last 79 years have we been able to hit this line here. Present day, previous time was in 2009, and before that, the only other case dating back to 1942 was 1983. Thus, this point here in 1983 and this point here in 2009 is similar to December of 2020. How did the stock market perform walking forward from those 2 dates? Longer term, the answer is very, very well. Shorter term, it helps us keep realistic expectations about 100% normal and to be expected volatility that occurs even within the context of the strongest trends. Even though really, really good things happen walking forward from 1983 from a longer term perspective, and really, really good things happen walking forward from 2009 from a longer term perspective, 2 weeks later, which would take us roughly to year end, and 1 year later, basically a coin toss. However, 2 years later, market was higher in both cases, and when we get out to 3, 4, and 5 years later, significantly higher. Average gain 3 years out, 38%, 4 years out, 67%, 5 years out, 73%. And historically, the drawdown over the next 2 weeks, which basically says the drawdown hypothetically, if we followed a similar path between now and year end, would be somewhere less than 2%. Of course, that is to be determined. A little bit deeper over the next year, average drawdown looking out 1 year from the date of the signal, which is this date and this date historically, was roughly 7%. Again, if you're into pattern recognition, there's one other item that may have already jumped off the page. Keep in mind, we just walked through these cases and said point A, B, C, D, and E are similar in both cases. I think you can make a rational argument that this look up here is a fractal of this look here and this look here. To help you understand that or visualize it a little better, let's zoom in on the present day here. And that's shown in this panel here. Notice there's a lot of similarities. Point A is where we start. Point E is where you draw the same box. Point C, the lower, is significantly higher in this case than point E, similar to this point C and this point C. In all 3 cases, D is higher than B, D is higher than B, and D is higher than B. And in all 3 cases, when we fall from D, we undercut C. When we fall from D, we undercut C. When we fall from D, we undercut the low at C. And then in all 3 cases, we get somewhat of an outside reversal look. We undercut these lows, and then we eventually rally and exceed the high at D. Undercut the lows, rally, exceed the high at D. Undercut the lows, rally, and exceed the high at D. We know what happened in this case after all that happened, and we know what happened in this case after all that happened. After making the higher high above D, really good things happened in the stock market for a long period of time. Same thing here. Really good things happened for a long period of time. Telling us to keep an open mind about something similar happening as long as this breakout holds above point D. Once again, this is a zoomed in look here of 2017 to 2020, right in here. There's lots of different ways to compare the 2 periods. If we compare the rally after this 21-year period, from 1982 walking forward, the secular trend, including calendar year 1982, the S&P 500 rallied for an additional 19 years. If something similar happened from the end of this 21-year period or the end of 2016, and we experienced a similar secular or long-term trend, Hypothetically, the current rally could last until 2034. The longer a market goes sideways, the bigger the move that you can expect to get if you get a bullish breakout. This is not a prediction. It simply helps us keep an open mind about a wide range of outcomes, and a wide range of outcomes on multiple time frames. This is a 19-year secular trend in here. Between point A and point B is the 1987 crash and a ton of volatility. This is a very volatile period here in 1998. Even if really good things happen on a day-to-day basis, it's never easy. Sometimes it's easier in the stock market. Before we switch gears to the next segment, keep in mind everything that we just covered was on a daily chart of the S&P 500. When we're talking about secular guideposts, we'll be shifting to a weekly chart. And a secular guidepost basically is used to help us ask an answer. Does it still look like a secular trend, or is it starting to drift from the secular trend look? Once again, a long-term look, weekly chart of the S&P 500, 1960 on the left side of your screen, the present day on the right side of your screen. This is the 200-week moving average in blue. This is the S&P 500 or price in green. So let's take a step back and see what we can learn from this chart. Notice how the look of the 200-week differs in here during the period of long-term consolidation. Looks different in here during the period of long-term consolidation relative to this period here or this period here. During the secular period between 1982 and the year 2000, you can see for the most part price stays above the 200-week moving average, or if it drops below it, it's a relatively short stay. Not the case here. So in the early stages of the secular trend, we drop below for a while here, but then recapture it. 1987, we go down and almost tag it, but rally. And in 1990, we do go down and tag it. We can make an argument that this near tag in 2016, this near tag in 2018, and this quick short stay below in 2020, earlier this year, are similar to these looks here that occurred within the context of a secular trend. Notice, those looks quite a bit different from this look here and this look here. This, and this, quite a bit different than all of this. And in both cases, those looks occurred after the long-term period of consolidation and a breakout, after the long-term period of consolidation and a breakout. The point of these exercises is not to come away with something that says today is like 1982, or today is like 1987 or 1990. What we're really looking for is similarities. This type of tag it look in 1990 was followed by one of the strongest trending periods in history. You can also make an argument we have a near tag here in 1995, a near tag in 1987 during a secular trend. You can make an argument that this collapse here and near tag is very, very similar to the collapse we just experienced in the present day. What matters here for us is, walking forward from 1982, 1987, 1990, and 1995, all three of those are bullish scenarios. None of them are longer-term bearish setups. That's the takeaway here. It helps us keep an open mind about the stock market performing better than expected over the next 2 to 5 years. And the concept of a guidepost says a chart like this can be helpful either way. If it starts to morph into a look like this or a look like this, or morph into something more like this, then we'll learn something about bearish probabilities. We just said this collapse here in 87, similar to the present day possibly. Thus, we can make an argument that it's possible the present day looks something like this period in here. This period in here, similar to this period in here. In both cases, here, a major low in 1974, 11 to 12 years later takes you to 1985 to 1986, right in this window here. Major low in this case in 2009, 11 to 12 years later takes you to the present day, the 2020 to 2021 window. Thus, we can make an argument that 2009 and 1974 are similar. If that's the case, then that's a good thing, because really, really good things happen for a very long period of time walking forward from 1974. Now let's examine the overextended question again, but this time from a little bit different perspective. Now we'll ask and answer. How extended is December 2020 versus the big three? It's possible in future videos we may have to refer to the big four after the big drop in 2020. However, let's stick with the big three for now. The big three being the 1987 crash, S&P 500 drop peak to trough 33.5%. Dot-com bust bear market, peak to trough loss in the S&P 500, just a hair under 50%. Financial crisis bear market, three of the big three, almost a 57% loss. Relative to the big three, let's ask and answer. Prior to the major market peaks in 1987, 2000, and 2007, how many consecutive calendar days did the S&P 500 close above the 200-week moving average? The 200-week is shown in blue. So let's look at the first case, 1987. The answer? The S&P 500 closed above the 200-week moving average for a whopping 1,831 calendar days. This is what an extended trend looks like. How about the 2000 case? How extended was the trend before the dot-com bubble burst? Quite a bit worse. 3,451 calendar days, with no close below the 200-week moving average. Also noteworthy, this happens twice in the same secular bull. How about the 2007 case, which really does not occur within the context of a secular bull? As we might expect, a little bit more muted, but still a long period of time. 1,152 days with no close below the 200-week moving average prior to this peak here. This number here is prior to the major peak. This number here is prior to the major peak. If we look at these three cases, unbelievably, the average period of time without a close below the 200-week moving average, 5.88 years. How does December of 2020 compare? Better, worse, or about the same? The answer is quite a bit better. It's not 1,831 calendar days. It's not 3,451 calendar days. It's not 1,152 calendar days. It's a much more muted 257 calendar days, or less than 1 year. Allowing us to answer this question with not very extended relative to the big three. How can all of this potentially help us for the remaining 2 weeks of 2020 and over the next 3 to 5 to 10 to 15 years? First, it's extremely important to understand what this is and what it is not. It is not a prediction in any shape, form, or fashion. No chart, no analysis, no one individual, no group can predict the future. We can assess probabilities. Thus, we're making probabilistic statements based on the facts that we have in hand today. If the facts change in a material way, we have to reassess the probabilities. Clients and regular viewers know that the only way any of this works under our approach, and yours may vary, is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.